This is Nightly Business Report with Tyler Matheson and Sue Herrera.
GE's profit slumps, so does its stock price, and fixing the company now rests on the shoulders of the incoming CEO.
Feeling the heat. It's summer. The mosquitoes are out, and now a Silicon Valley firm is launching an experiment to cut the numbers of them and reduce disease.
Cooking up success. How a few hardworking entrepreneurs became food truck millionaires. Those stories and more tonight on Nightly Business Report for Friday, July 21st.
Good evening, everyone, and welcome. An uphill battle for General Electric. Its challenges were magnified today when the company reported a nearly 60% drop in profit. Its earnings forecast for the year, disappointing. Revenue in the most current quarter also fell. The problems are well known. Its energy business continues to reel from low oil prices. Its transformation back to a pure industrial company yet to take hold. Investors were not pleased with CEO Jeff Immelt's final earnings report. The stock, which you likely own in a mutual fund, an ETF, or a retirement account, was off nearly 3% today. So how deep do the problems at GE run? Well, just take a look at this. General Electric is the worst performing Dow stock since Mr. Immelt took over in 2001, off 36%. Turning things around will be up to the incoming CEO, but he didn't offer any details of his plan during his guest appearance on today's earnings conference call. Dominic Chu has more.
If there's one word that could be used to describe the story at General Electric these days, that word would be transition. And in some ways, it's that transition that helped drive GE shares to multi-year lows in trading today. While GE did reiterate its current year guidance, it declined to go into what it thinks about next year. Incoming CEO John Flannery spoke on the company's earnings conference call about why.
As you know, my official start date is August 1st, and we'd indicated earlier that I'd be doing a full review of the company and be back to investors in the fall with my views. We're on track with this process. I'm in the middle of a series of deep dives into each of the businesses. We're looking at everything you would expect. What is the market outlook? Where can we grow? Where can we improve margins? How is the cash conversion? What returns are we getting on investment?
The transition to CEO John Flannery from current CEO Jeff Immelt means the next few months will be spent taking stock and evaluating each of GE's businesses to set an appropriate outlook. General Electric stock has been a notable laggard in the market and has yet to recover its record highs dating back to the dot-com boom of the late 1990s and early 2000s. Over the past decade, GE has made bigger bets on oil and gas as well as power generation systems, bets that haven't paid off and remain a drag on the company's revenues. But experts still think clarity about future plans is key for GE.
People wanted to hear something about the 2018 outlook, and there really wasn't much about 2018. I think Jeff Immelt and Jeff Bornstein kind of talked down the numbers here in 2017 a little bit toward the low end of the $1.60 to $1.70 range. You know, I don't think people necessarily like that, but I think we knew coming in that power and oil and gas were going to be a bit weak. So nothing's really surprising there. I think the biggest issue is that they kind of left us a bit in limbo without waiting for this November analyst day.
Incoming CEO John Flannery will have the daunting task of trying to turn around one of the most storied and complex businesses in the world. But investors may have to wait until at least November before any turnaround plans become evident. For Nightly Business Report, I'm Dominic Chu.
So why is GE struggling, and how can it get its mojo back in business and in the market? Kevin Quigg is chief strategist with ACSI Funds, joins us now to discuss. What is GE in your view, Kevin?
GE is a company in transition. I think you just talked about it. Really, their challenges are twofold. Number one, they're a company that's going back to basics, back to their core, and that obviously provides a real challenge in deciphering their numbers. The other challenge they have, frankly, is their direction. So the change of CEOs on top of the change of corporate headquarters, on top of all the other changes they have going on, it's creating a lot of uncertainty in the stock.
They've sold some of their core. They've gotten rid of the appliances, the light bulbs and so forth, and they're focused, I guess, on infrastructure, energy, medical devices, locomotives, jet engines?
That's right. So they're going back to those businesses, and really the effect you're seeing is the cash flow in the earnings today was affected by the lack of appliance revenue. Some of those businesses have injected in volatility into the GE model, and it's going to change the way you have to look at the stock moving forward.
Kevin, you know, basically the stock has been dead money for 10 years or more. Why hold GE? They've been trying to transition since 2001, since Mr. Immelt took the helm, and they haven't been able to execute quite as effectively as the market certainly thinks they should have. And they've had an activist investor as well, which usually moves the stock. It hasn't moved GE.
It hasn't moved GE because I think they haven't clearly stated effectively what their plan is for the future. So I do agree that the pressure they're getting from Tryon, some of the other pressure they're getting on the street is affecting their decisions day to day. And really the way they could clear the decks is to state which businesses they want to invest in, state how they're going to invest in them. And most importantly, as an investor, what should I be looking at in terms of progress? What areas of those earnings are important?
Do you own it in your funds right now, and would you add to it if you did?
We do own GE in our funds, and right now we would consider it a hold because, again, our guidance internally has been it's not moving down or up. It's kind of just treading water until the new CEO takes place, until the new plan takes place. And at this point, from an investment standpoint, you're right. You've waited 10 years to take action on GE. At this point, you know, the light is at the end of the tunnel, and Flannery is going to be a successor. He's not. I want to give him an opportunity to see what that plan looks like, to see what the stock's going to do. Well,
he was in one of the most successful arms of GE, and it has been able to execute in that division. I guess the question is, can he take what he was able to achieve, I believe it was in healthcare, into the other aspects of this industrial company?
Well, I think he has, and the real challenge for him, frankly, and he did do well in the healthcare part of the organization, but how clear are the decks going to be when he gets there? So they've reduced about $650 million off their industrial expenses. The goal is $1 billion. Is he going to have free choice to make decisions, or is he going to have to continue some of the things that are taking place under Immelt moving forward?
Kevin, thanks very much. Kevin Quigg with ACSI Funds.
Thank you for your time.
And on Wall Street, General Electric was a drag on the Dow, and the Nasdaq snapped its 10-day win streak. The blue chip Dow index fell 31 points to 21,580. The Nasdaq was off 2, and the S&P 500 was lower by a fraction. Their performance was mixed for the week, which saw all of the major averages hit new highs. As for oil prices, they fell today after a report came out and it doubted OPEC's commitment to its production cuts.
Oil prices and energy costs are a key component of the economy, an economy that hasn't been growing as fast as many, including many investors, would like. But a few economists say there is a way to increase growth and maybe even get it above that elusive 3% rate. Steve Leisman takes a look.
A quartet of leading conservative economists are arguing in a new paper that the U.S. isn't stuck forever with sub 2% growth. They say 3% is realistic if the right policies are pursued. John Cogan joined with John Taylor and Kevin Warsh and Glenn Hubbard to say that attaining 3% annual GDP growth rate is based upon enactment and implementation of a package containing significant tax reform, regulatory reform, budget reform, and monetary reform. Taylor, Warsh, and Hubbard are all believed to be under consideration by the Trump administration for positions at the Federal Reserve.
The thing that this business cycle was different in was the collapse in capital spending. That has been the biggest explanation of the decline in productivity. Better tax policy can help to turn that around. Tax policy can also help with hours worked, but we've got to actually do it. We can't just talk about it.
Productivity growth, or how efficient the economy is, and growth in hours worked, or growth in the labor force, are the linchpins of overall economic growth. If you work more and work more efficiently, you grow more. The paper argues that the wrong economic policy of the Obama administration are the chief culprits in the U.S. slowdown. The Congressional Budget Office and many economists think that economic growth is capped at below 2%. Liberal economists blame more of the shrinking workforce on baby boomer retirement, and they're skeptical the government policy can boost productivity by a full percentage point, as claimed by the authors of the paper.
There are lots of credible studies that show cuts in marginal tax rates will boost productivity growth, will boost investment a tiny little bit.
Putting in place policies that lead to better economic growth, that's one thing. The danger is if the Trump administration and Congress budget and spend for those higher growth numbers and then they don't appear. Deficits could surge, and that can reduce the impact of the pro-growth policies. Even the authors of the paper agree with that. For Nightly Business Report, I'm Steve Leisman.
On Wall Street, next week is a big one for earnings. 13 Dow components and about 1/3 of the S&P 500 released their quarterly results. And there's one school of thought that earnings could drive the stock market rally. Bob Pisani tells us why next week is a big one for investors.
Earnings season is heating up and things really get off to the races next week. We're about to enter the busiest stretch for earnings with roughly 180 S&P 500 companies and more than a dozen Dow components reporting quarterly results. That includes a number of big oil companies like Chevron and ExxonMobil, industrial names like Caterpillar, consumer goods giants like Procter & Gamble, and tech titans like Facebook and Amazon. And that's just the tip of the iceberg. Next week will be crucial to watch because so far analysts have high hopes for the season. Second quarter earnings are expected to jump almost 10% from last quarter. That's up from 8% at the start of earnings season for the second quarter. And revenues are also picking up. That's why the stock market's up. More companies have been beating on earnings, and they've been beating by more than usual. But the growth has been confined to a few key sectors. So other than energy, technology is supposed to be the single biggest contributor to earnings growth this season, and tech stocks have been the biggest winners so far this year. Tech earnings are expected to be up 16%. Keep an eye on energy earnings. Energy stocks are way above historic values because everyone has gotten the price of oil wrong this year. They jacked up estimates because they assume oil will be $60 now, but it's stuck in the mid-40 range. And those earnings estimates have already been coming down. That's why energy stocks have been down this year. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
A shakeup at the White House today. The veteran Wall Streeter Anthony Scaramucci is the administration's new communications director. He's the founder of the investment firm Skybridge Capital, a firm he has since sold. He is expected to begin his new job in August. Leaving the White House, meantime, in August, is Press Secretary Sean Spicer, who resigned today and who reportedly disagreed with the appointment of Mr. Scaramucci.
Still ahead, the economy is changing quickly, and our market monitor has a few ideas of how you can invest in the future. The government has decided to drop criminal charges against former J.P. Morgan traders in the London whale case. According to a court filing, efforts to extradite the defendants have been unsuccessful. Officials also say they can no longer rely on the testimony of one of the former traders. The traders, as you may recall, made some risky bets on complex financial instruments, which resulted in losses of more than $6 billion for the bank.
Step outside in the evening these days, and you probably have to shoo away a lot of mosquitoes. The insects seem to be everywhere this year, and some, of course, carry disease. After all, it was just a year ago there was rising concern about that bug-borne Zika virus. Now there are some new experiments underway to limit the mosquito population, including one being done by a big technology company. Meg Terrell reports tonight from the Florida Keys.
Here on this block in Key West, Florida, scientists are working on a new method of controlling the world's deadliest animal, the mosquito. It accounts for more human deaths than any other animal on the planet, most due to malaria. Here in the U.S., we have the mosquito that carries Zika, dengue fever, and other diseases, the Aedes aegypti.
The history of mankind tells you mosquitoes are bad news.
Scientists are now trying to suppress numbers of those mosquitoes by releasing more mosquitoes. It sounds counterintuitive, but these bugs carry a secret weapon, a bacteria called Wolbachia. When male mosquitoes with Wolbachia mate with wild females, the offspring don't hatch.
We'll release right here. This is a really good spot.
In its trial, Key West is releasing 75,000 male Wolbachia mosquitoes every week.
Because males do not bite, they're harmless to people, and so they can't spread diseases.
These are not going to bite us. These are not going to bite you.
Okay. 3,000 miles away in Fresno, California, a similar experiment is taking place on a larger scale. Tech giant Google, through its health subsidiary Verily, is conducting a trial it calls Debug Fresno. And no, this isn't software. Google's working on actual bugs, releasing 1 million male Wolbachia-carrying mosquitoes each week.
We've developed automation that can automatically rear mosquitoes, separate the males from the females, and then release them in the field. And so we've lowered the cost of being able to do this tremendously.
Many may ask, given the toll they take on humanity, why not just kill all the mosquitoes?
With a gene drive system, we could simply spread infertility.
Kevin Esveld studies evolution at MIT. A technology called a gene drive, he says, could theoretically be used to force inheritance of genes that cause sterility, wiping out a population. But he warns that technology is too powerful to be considered lightly.
It spreads indefinitely. There are only a handful of problems that are so severe that it might be worth using this kind of gene drive.
Malaria, he says, may be one of them. But for now, tests here in the U.S. are starting smaller. Just this one mosquito and a technology that doesn't spread indefinitely. For Nightly Business Report, I'm Meg Terrell in the Florida Keys.
Honeywell raises its outlook for the year, and that's where we begin tonight's market focus. The aerospace and defense giant raised its earnings and revenue guidance for 2017 after it reported profit and sales that grew and topped estimates. The company said the strength in the latest quarter came from its performance materials and technologies businesses. Shares rose 1% to $136.35. Schlumberger said it plans to take a controlling stake in Russia's Eurasia Drilling. The oil services giant attempted to acquire a 45% stake in the Russian company back in 2015 for nearly $2 billion, but that deal fell apart. Schlumberger also posted quarterly results that were better than expected. Shares of Schlumberger fell a fraction to $66.53. Sales slipped at Colgate-Palmolive, missing analysts' expectations. Earnings were in line with estimates, and the consumer products company said it expects revenue for this year to rise in the low single digits due to uncertainty in global markets. But the shares managed to gain more than 1%, ending the day at $73.27.
Despite facing higher costs, credit rating company Moody's saw both profit and revenue edge higher. The results were stronger than expected. The firm also raised its full-year sales and profit outlook. Shares jumped 4% to $132.57. The Swedish auto safety equipment maker Autoliv said lower than expected vehicle production in China and North America would cause organic sales growth to slow this year. For the latest quarter, the company reported earnings and revenue that came in shy of estimates, and shares fell today nearly 8% to $106.78. The pet medication distributor PetIQ went public on NASDAQ today. The company priced more than 6 million shares at $16 apiece. The CEO said going public was the right move.
We've got a lot of growth strategies the company has put out there that are important. There's a very large number of consumers that are virtually unaware that they need to provide the kind of pet health care that's available. So us being positioned with more capital just makes us be available and in a market that we can do what's required to expand that. So it's a time for us to really implement our growth strategies, bring consumers in, hopefully help those pet parents.
A good day for PetIQ. Shares up 45% to $23.32.
Our market monitor has some names of growth stocks, he says, that are all about the future. The last time he was on in January, he recommended Blackstone, which is up 14%, Global X Master Limited Partnership, that's down 5%, and Microsoft, which is 18% higher. Joining us tonight is Ron Wiener. He's the partner at RDM Financial Group at Hightower. Ron, welcome back. Nice to have you here.
Hi, Sue. How are you?
I'm good, thank you. You say the future is in technology, utilization of the internet, and biotechnology in healthcare. So your first pick for us is the Spider S&P Biotech ETF, XBI.
Right. So this is about 90 companies. They're equally weighted. They're small, mid, and large companies. A lot of investors that go in this space buy the IBB, which are the large companies. But we see the action in the small and mid companies. We just saw a big cystic fibrosis discovery. The XBI moved up on that. It was a holding. There's just a lot of future in biotech, and it's going to be the future, and that's where we want to go. We want to go to the future. They dropped significantly last year, so there was an opportunity starting around January to get in here, and it's got a long way to go.
All right, let's move to your second pick, which is Google. Tell me about why you like that one.
Well, we just heard from Meg about Verily. Google's in a lot of businesses. You think about it, Android, YouTube. YouTube downloads 300 hours of video per hour. They are the future. They're into artificial intelligence, machine learning, they're smart management. We got to look to the future. Google's part of that future. So it's a good business to buy.
And your third pick is Alibaba, and you say Alibaba is Amazon on steroids. Tell me why.
Full disclosure, we were down for a whole year owning that stock. Now it's up. I came out with it on Market Monitors a year ago. It's up 89%. Still, I brought it back because it's got a long way to go. They're 57% of the B2B in China. They're the Amazon of China. They're now got into Ali Cloud. They're multinational now. They're just growing like a weed. The consumption in China is going to go from 42 trillion to 65 trillion in 5 years. That's 1.3 times the entire size of Germany. So there's so much growth. It's almost scary.
We like that you come back to one that you mentioned a year ago, and as you did with Google, and they've both done well, and you come back to them. I think that really shows your commitment. Talk to us a little bit about this Global Master X Limited partnership, which is the only one of the ones which is down a little, though you point out that it has outperformed the energy sector and has a nice yield of 7%. You still like it?
Sure. Oh, yeah, we still own it. We did trim a little because of opportunities in foreign and other things, but the yield's about a little over 7%, and it's tax advantaged. But the key is that their pipelines, their storage, their processing, it's not oil. It gets lumped in with oil. I think oil was down 17% in the same time period as we were down 4%, but half of our investors are retired. So we search for yield other than bonds, which we think are not going to yield a whole lot, interest rates probably going up. So it is a solid company. All the exporting, the U.S. is going to be a major exporter of oil and natural gas, and we got to get pipes to the Gulf Coast. We got to get pipes, to the Northeast. It's a great business. It just gets caught up in oil, but it's not oil. It's a great growing business.
All right. On that note, Ron, thank you so much. Have a great weekend.
All right, thank you.
Ron is with RDM Financial Group at Hightower.
And coming up, rolling along and making millions in the process.
The Federal Trade Commission is reportedly looking into whether Amazon's discounts are as good as they seem. As first reported by Reuters, a consumer watchdog group said the online retailer routinely uses inflated and fictitious previous prices to mislead consumers. The FTC had no comment, but Amazon refuted the group's pricing report, calling it deeply flawed.
Ford is fighting an immediate recall of Takata airbag inflators. Earlier this month, Takata added more than 2.5 million vehicles to a recall that already affects more than 40 million cars. These inflators were once thought to be safe, but the government says they pose a safety risk if not replaced. Ford says there's no data suggesting that a recall is needed.
Lyft is now building its own self-driving car technology. The ride-hailing company believes that by 2021, the majority of its rides will be in autonomous vehicles. Today's announcement marks a shift in that company's strategy. In the past, it had been content to partner with automakers and tech firms. Now it's developing its own software.
Well, from self-driving cars to food trucks, there are a growing number of them. You've probably seen them. For entrepreneurs who love to cook, the Meals on Wheels route is a lot less expensive than opening up a traditional restaurant. And food trucks are turning out to be very lucrative for the best operators. Kate Rogers has our story.
When Ben Van Leeuwen and his partners started making their artisan ice cream in Greenpoint, Brooklyn back in 2008, they had no idea what a hit it would become.
There you go.
With just $50,000, Van Leeuwen Ice Cream hit the streets of New York City looking for the perfect location.
We drove to the corner of Green and Prince, and by the time we had opened the window, there was a line of 30 people. This is the peanut butter chip.
And the crowds kept coming. Today, the company has 6 food trucks and 9 storefronts in both New York and Los Angeles. Their ice cream, featuring unique flavors like honeycomb and vegan mint chocolate chip, even retails in Whole Foods in the Northeast and California. And the business is on track to do $20 million in revenue next year. Food trucks like Van Leeuwen's have been growing at a faster rate than traditional restaurants over the past decade, but that growth is expected to slow in the years to come due to regulatory hurdles.
It's very challenging to make them work financially in New York City. In other markets, it's much better. In Los Angeles, it's very truck friendly.
In Austin, Texas, former attorney Eric Silverstein launched his food truck, The Peached Tortilla, back in 2010 after he couldn't raise the capital he needed for a brick-and-mortar restaurant.
Biggest challenge early on was just staying mentally strong and trying to run this business when you're not taking a paycheck. If you're doing it, you got to be ready for, an all-out war on the street, basically.
Silverstein won that war, eventually opening a restaurant featuring his Asian and Southern-influenced tacos. He still takes his 2 trucks out for lunch and catering and expects to do more than $3 million in revenue this year.
You are all set with your heart attack.
MacMart's Marty Lieberman also went the brick-and-mortar route after her mac and cheese food truck became a hit in Philadelphia in 2013.
It was only within the first few months of being on the truck that our first catering jobs came in, which is an aspect of the business we didn't even realize would be so lucrative.
She and her sister Pamela wound up launching a MacMart storefront, still using the truck for catering and private events. The truck is booked up through 2018, and her business is set to do about $1.5 million in sales in 2017.
People come from New York, people come from Los Angeles, people have come from England. We get requests from Brazil. It's just super rewarding to hear how many people love our product. You have a wonderful day.
For Nightly Business Report, I'm Kate Rogers.
And to read more about food truck millionaires, head to our website, nbr.com.
Every time we do a food story at the end of the show, I get
hungry.
hungry.
Time, right?
It's dinner time. That does it for us. I'm Sue Herrera. Thanks for watching.
Thanks for me as well. I'm Tyler Mathisen. We'll see you back here Monday.